Brent, very good to see you. Today we get to talk through how to minimize capital gains tax. So we're going to talk through 4 strategies that range from timing to charitable giving to certain investment techniques. So let's start by explaining when you're on the hook to pay capital gains tax. What do we need to know?
Yeah, in our world, you're on the hook when you take after-tax dollars and invest them in a brokerage account, sometimes called an individual, sometimes called a TOD, but essentially it's after-tax dollars. So this is not like your retirement accounts where it's pre-tax dollars. So you make those investments in those after-tax accounts. When they appreciate and you liquidate, it's very important, when you liquidate, whatever that gain is, that's where you could owe capital gains taxes on. And so for most people, they're going to be in the 15% range, but there are some lower earning individuals who are in 0 and then some high income earners where they pay 20%. But for this conversation, 15% capital gains rate is a good discussion point.
Okay. So now let's talk through those strategies then to minimize those taxes. And the first strategy would just be bite the bullet, pay the taxes now because we are living in a historically low tax rate.
Correct. So if you look at this chart here, it breaks down that yes, taxes are lower when you look at things in the long run. And so, it may make sense to just go ahead and liquidate some of those positions and then pay the taxes now. There's also a lot of political rhetoric going on where they want to change capital gains rates to ordinary income tax rates. If that happens, that's bad news for most.
Yeah.
So it could make sense to take some of those gains now.
Yeah, that would be a big deal. All right, next strategy would be to consider a donor advised fund.
Yeah, these are definitely for the charitable minded people out there. And so essentially one tactic you can use is you take some cash, you take some investments from that brokerage, move it to your donor advised fund, which is a fund that, we could assist with setting up. And then the assets are now in that fund protected from taxes. You get a deduction based on the amounts that you put in there. And then you've kind of got this slush fund that you can give to your charitable causes. So we've done this with some of our clients. And then we've also done a little bit more is donating appreciated stock positions to maybe a church. Like Kim and I personally, that's how we tithe. We take appreciated shares, ship it over, church benefits, we get a tax deduction. So there's definitely
very tax efficient.
Absolutely. So those are some options you have there to kind of get out of the taxes.
Yeah. And speaking of taxes, the other strategy would be tax loss harvesting. How does this work?
Yeah. So say you've got some gains in there and you've taken them for one reason or the other, you needed to liquidate it. Well, a lot of times at the end of the year, you can look at your positions and say, okay, do I have any losers out there? Okay. Because if you sell some of those losers, those losses can offset your gains. So that's going to lower your tax bill if done correctly. And we do that for a lot of our clients. Now, one thing to keep in mind is there's some wash sale rules. Long story short, wait 30 days before you buy that same position. Or, in our opinion, we don't like to stay out of the market longer than we have to, just buy something else. Right. So if you sell a loser, find an asset that's similar and then just make that purchase.
Okay. And then the last strategy, make sure that you are holding that asset for more than a year. Why is that?
So if you were to buy a share today and then sell it in a week at a 10% gain, you're going to have short-term capital gains. Anything that is under a year in holding period, you have short-term capital gains. You are going to pay that at your ordinary income tax rate. So if you're in the 22% bracket, that's what you owe. By holding it for a year, it moves into a long-term capital gain, and that's where it goes back to that 0, 15, 20. You're going to fall somewhere in there. And so, yes, like we often tell people, we're not day traders. We're not moving things quickly like that. You're looking for long-term capital gains, and then you're looking for planning around that. Right. But if you have to sell something, just understand if it's under a year, you're going to pay a little bit more in taxes.
Good to know, though, there are some strategies to minimize those taxes. Brent, if somebody would like more information about what we've talked about today, how can they reach you?
Yep, young-wm.com. And then you can also go and call us at 614-430-8383. We would love to talk about it.
All right. Brent, thanks so much for your time today. I appreciate it.
Thank you.